Financial planning goes beyond investments. It's all about owning a clear path to the future with a well-thought-out combination of investments and insured outcomes. It's a process that can lead to true long-term financial independence. If you live in Gilbert, work with one of the best advisors in Arizona, Steve Jur-itch with IQ Wealth Management in Scottsdale. Steve will take the time to make sure you get the right plan right from the start. Let's listen in on Steve's popular daily radio show, Mastering Money on Money Radio. At any point throughout, you can visit our website by clicking the little circle with the I in the top right corner.
2 in the box.
Ready to go.
We be fast and
They be slow.
Welcome back to Mastering Money on Money Radio, right after Business for Breakfast from 8 a.m. to 9 a.m. and again at 6 p.m. Monday through Friday. Mastering Money brought to you daily by best-selling author and wealth manager Steve Jur-itch.
How you doing, everybody?
Steve is founder of IQ Wealth Management in Scottsdale, an independent registered investment advisor and fiduciary, an A-plus accredited member of the Better Business Bureau with asset custodian Fidelity Institutional. Steve is a local hometown advisor with national resources working with him and is part of an integrated network, including Sterling Capital, with more than $52 billion under management. Steve helps clients build durable, comprehensive, low-maintenance retirement strategies and is the designer of the Black Diamond Dividend Portfolio. It's time now for Mastering Money's Q&A session. Today, how about this?
No.
I'll handle the Q's.
Okay.
Steve, you get the A's.
All right, let's do it.
Speaking of the Black Diamond
Yeah.
portfolio, you designed and developed the Black Diamond dividend strategy.
Mm-hmm.
So how does it differ from other dividend portfolios?
Well, Ken, a lot of people like dividends. A lot of people look for dividends within their different investments or mutual funds that they choose. Dividends are always on a check the list, and check the box type of thing when people are considering various different types of mutual funds or ETFs. But the fact is that if you want to get scientific about dividends, it's one of the very few ways that you can actually get some certainty out of what's happening in the markets. The markets, of course, are uncertain by nature. That's what a market is. It's up today, down tomorrow. It's up this year, down next year. We don't know. We have to have some certainty if we want to be investors. I mean, there's just a big difference between speculating and investing. Investing means that you are actually going to get all of your money back somehow, some way from income coming in from the investment. So that whether that's a rental check, whether that's a dividend. So the fact of the matter is that the most, I guess you could almost say, the most proven way of growing wealth for the largest number of people over the past 20, 30, 40, 50 years has been getting serious about dividends and allowing those dividends to come into your account and allowing those dividends to purchase more shares of stock. Why it works so well, of course, is that when there are market pullbacks, which most people are concerned about right now, Ken, you've got to have a way to defend yourself, A, but B, have an offense. And the best offense, everybody talks about buying low and selling high. Mm-hmm. How many people really do it? When you have not too many, but when you have a dividend reinvestment program that is just switched on all the time, and you're requiring a minimum of a 3% dividend yield from companies that are actually making profits, and not just this year, that have increased their earnings and dividends 10 consecutive years or longer. So the bottom line is that we're looking for the cream of the cream, if you will. The fact is that you can buy dividend aristocrats on their own, and that's a benchmark we look at, but we take those dividend aristocrats, dividend achievers, and cull them out because there are a bunch of dividend aristocrats, those stocks that have increased their dividends 25 years or longer. But the fact is that some of them are down to about a 1.4% dividend yield, which means that stock's overpriced. So the Black Diamond Dividend Portfolio, minimum 3% dividend yield, minimum 10 years of increasing dividends.
Now, Steve, with interest rates this low, bonds are almost out of the question for anyone needing reliable retirement income.
Right. Mm-hmm.
Now, that's a huge switch from retirement planning just 10 years ago when bonds were paying 5 and 6%,
right.
Even 8%.
Yeah.
What are retirees faced with now, and what are some ways that you can help them at IQ Wealth Management?
Well, retirees are kind of in shock. These baby boomers retiring now remember their parents retiring on pensions with no debt, and being able to live on $4,000 to $6,000 a month easily and really enjoy themselves. And if some people had pensions back in the day of, $40,000 a year, you got Social Security on top of that, and then you could get the rest from your CDs. Just a bank CD used to pay 8, 9, 10%. That's all changed right now. Many people have pensions, but maybe it's not enough. Also, lifestyles have changed and inflation has occurred. If you were bringing in $50,000 a year from retirement savings in 1990, today that's only worth $30,000 a year, and in another 20 years, we don't know that won't be down to $15,000 a year. Could happen. So the bottom line is people are faced with making sure that they can match all of their liabilities going forward, and that's what is so important today. People focus too much, Ken, on, hey, what rate of return can I get on this asset or that asset? That's important, but you don't want the rate of return to drive your decisions. You want to get organized. You need to have a strategy, and the strategy should drive which products are chosen. So the bottom line is people really want less risk, lower fees, reduced stress, principal protection, liquid access, exceptional income, and they want one main thing, lasting financial independence. And how do you get it? That's by focusing on those liabilities. And we do what's called liability planning. That's where we start when we're putting together a retirement income plan. You've got to have guaranteed income that is equal to or greater than your liabilities today, 10 years from now, and 20 years from now. If you can handle that, then you can go out and invest after that. That's where you hear us say, insure your income, insure your outcomes, then invest the rest with purpose. So focus on your liabilities and focus on ways to get guaranteed income to match those liabilities without settling for these bond funds or junk bonds and things like that.
Now, Steve, I've heard the term simplifying the complex. Mm-hmm. Is that what you do at IQ Wealth?
Yeah.
And where does the Safer Buckets retirement system come into play?
Well, the fact of the matter is yes, if you're going to an advisor, you're not going there to listen to more complex situations. You really want life to get simpler. And where we start is a person's purpose of their money. What are they really trying to achieve? What's their legacy motive? Are they looking to leave a whole bunch to kids and grandkids and others? Or are they looking to make sure that themselves and their spouses are very secure, and then whatever's left over, the kids get the rest? That's typically, number two is typically where it's at these days. But we focus on the purpose of the money, the principles of the client. What is it that they're most focused on, and what do they want to most achieve? Their priorities, because, everybody's financial, you can have $2 million, and yet you're still limited on what you have. You still have to focus on certain priorities. Irrefutable logic and simple math. That's how you simplify things. You don't try to just, skate over the top of thin ice. You want to make sure that you are actually separating your money into categories, and you have to have a financial plan that matches how you're going to think, how you're going to feel about life, and where you're going to want to have your money allocated, so that if you want to travel, you get to travel. If you want to set aside more for long-term care, we can do that. To have an organized plan, we use what's called the Safer Buckets retirement system. 4 buckets. Bucket number 1, cash. Enough cash, 3 to 6 months, sometimes 9 months of surplus living expenses at all times, right at your fingertips in money markets or bank accounts. Bucket 2, your income bucket. This needs to be insured low-risk money. It shouldn't be income that you have to wonder how the market's doing or where interest rates are. This money, of course, includes your Social Security and any pensions that you have, but it also, that's where we do utilize annuities, because with the right annuities, you can actually get more income using fewer dollars, which by concentrating those dollars with higher profile or higher powered income vehicles issued by companies over 100 years old for a lifetime, well, you now have your liabilities handled out 20, 30 years, even 40 years. If your spouse is 55 years old, you've got a plan for her for 40 or 45 years. So that's the income bucket. Bucket number 3 is the growth bucket, and the principle there is we want to remain invested. If we've got your income covered and your cash needs covered, well, now we want to make sure that you can be a little bit more, I don't want to say aggressive unless you want to be, but at least moderate. Remain invested. Reinvest your dividends. Compound your equity growth. And double your money every 10 to 12 or 15 years in the growth bucket. Bucket number 4 is the outcome bucket, and that's where we address a person's legacy motive. You know, in retirement, you're in decumulation. You're no longer in accumulation. So the bottom line now is it's a battle not to run out of money, but not just to not run out of money. That's one of my pet peeves. You see these things online and they say, well, you're not going to run out of money. You're okay through age 90. After that, we'll see it. Your investments need to be okay. Bottom line is if you've run down 80% of your money by the time you're 85, you're not feeling good about life. And by then, who knows what inflation's going to be like. We'd like to see you on a steady path with your income and a growth path with your growth assets. And then bucket 4 handles things like how much do you want to leave? If you want to leave extra, we get life insurance. If you want to protect against the ravages of long-term care, which by, in 20 years, what's that going to cost? It's going to cost $100,000 a year for sure. And if both spouses need 3 years of it, that's $600,000.
Wow.
So these are the things that we address, and we do it very well with the Safer Buckets retirement system.
And you're listening to Mastering Money here on Money Radio.
To learn more about the process that can lead to true long-term financial independence, or to hear the rest of this radio show, click the link and visit the IQ Wealth Management website. If you want to retire and stay retired with the right strategy for you, take a few seconds and click the link on the screen now.